What's up, guys? I hope you're doing well. James here from jamesdforsythe.com, and to explain a little bit about the background, basically just sitting on a curb somewhere in the hotel parking lot, working out of town. I'm one of those long stints again, no longer sharing a room, so I can't just steal the truck keys and sit in the truck to do the video. So we're under a street light in the parking lot. But regardless, kind of going a little bit further back in history for the Federal Reserve itself. And so going over a letter specifically from July 27th of 1910, right? It was written for the Merchants Association of New York. I'm going to give some numbers. But basically just a letter given by Irvin Fisher, I think, if I get to flip to the right page. Irvin T. Bush. Irvin Fisher, someone else. But anyway, he's the chairman of the Currency Committee of the Merchants Association of New York. So this is one of the associations that Paul Warburg dealt quite a bit with in terms of the whole. He interacted with them quite a lot in order to kind of gauge and also kind of influence the kind of public sentiment towards the Federal Reserve, right? And during its inception and kind of developing the need or the belief for a need for a central bank, right? And so to get right into the letter itself, so the Aldrich-Freeland Act of 1908 was passed avowedly as a temporary measure and is only a makeshift which will soon lapse by its own terms, right? So it was only temporary, and the Aldrich-Freeland Act is kind of known as the first Aldrich Bill, right? It's sometimes referred to, and so it can get kind of confusing sometimes when you're looking through some of the old literature, right? Because if you see just the Aldrich Bill, you have to look, okay, was it the 1908 one, which is really the Aldrich-Freeland Act, or is it the 1912 one, right? And so that being said, and so basically looking into, again, it's repeated multiple times throughout the whole book. Again, this can all be found in the Federal Reserve System, its origins and growth, Paul Warburg's book, which is cited quite a few times in a lot of the different Federal Reserve literature I've found, right? And so basically the reason for such a Central Reserve System was the reason for this new system was because the problems of the previous system, which naturally, as you've probably heard for the argument multiple times, is the inelasticity of the banknote, right? So to explicitly say, first, its banknote circulation lacks elasticity, promptness in distribution, and celerity of redemption. And then second, the banking reserve is so scattered as to be unavailable in times of emergency, right? So basically it's so decentralized they can't do anything with it. Basically the whole system becomes a liquid, right? And so basically he gives two classes of solution, right? And this isn't Warburg, this is Bush, according to his letter, right? So the first class involves power to be conferred upon the 7,000 national banks of this country to supply themselves at need with full currency requirements, basing their issues upon the maintenance of individual reserves, right? So it seems like everyone has their own reserves, and they basically more or less supply themselves with their own currency, right, to fulfill their needs, right? And so the establishment of redemption or safety funds, and upon bank assets either generally liable or specifically pledged, right? And then for the second class is basically Warburg's plan, right? The centralization of reserves, right? And so a central institution to concentrate into one central reservoir a portion of the lawful money reserves of all the banks, state and national, to devote itself specially to the management of the currency and to the rapid solution of currency problems, right? And so three major reasons against this, what was really given. So basically the major objections against the establishment of a central bank in the US at this time were: one, the danger of political control, two, danger of control by special interests, and 3, hurtful competition with existing banks. And so I'm going to touch more on the third one with the competition of, sorry, I'm having to hold the phone. And so the hurtful competition of existing banks, this was one of the major reasons for also having, there was a big argument in the kind of drafting of the Federal Reserve Act itself with having with the amount of districts for the reserve banks, right? Because the argument was like each little regional reserve bank is kind of their own central bank in a way. And so if you don't have them kind of guided by a centralized policy, especially like we have now with the Board of Governors and the FOMC, that sort of thing, then you would basically have them compete with each other. And so basically, this is also why member banks can only be within, or can only interact with their regional reserve bank, right? Or supposed to, at least in the original drafting of the bill. So there's that being said. And then after saying this, right, this is the conclusion of this guy's letter, and which is kind of inspired, I guess you could say, the title of this video. So, with such an institution in existence as the Federal Reserve Bank, he proposes, he being Warburg, a currency famine and money panic would become impossible. The monetary reserve would be effectively utilized, the national treasury relieved of all responsibility for the money market, and international exchanges and movements of gold easily regulated with immense benefit to all producers, distributors, and consumers alike in every station of life. Right, so basically this is the end-all be-all of central banks and will be perfectly fine, and no problems could ever, like any currency problems or illiquidity problems in the system, any systematic risks involved in the monetary system would be negated and impossible, apparently. And we know basically from, I'm not sure quite what his argument would be for the system we have now, because it has changed a little bit, but it's still like, obviously that's not our experience with the Federal Reserve System. Right, and so kind of a few more words on Warburg himself and the kind of the purpose of his dealings with this committee of the Merchants Association in New York. He even talks about, so the articles that he published between this period of 1908 to 1910, right, was pretty much explicitly to arouse public opinion, his own words, and then basically arouse them to recognize the fact that banking reform in the United States, in order to be successful, would necessitate the radical change from decentralized to centralized banking, right? So you can centralize everything in terms of monetary reform, right? So reviewing these efforts in their chronological order, one can readily perceive how step by step the central bank thought advances, but how new trenches always remain to be taken. With each new attempt, the method of attack had to be changed, and at the same time, the proposals for the adaptation of the central bank thought to American businesses and political conditions had to be further evolved and improved. Right, and so this, I want to make one comment about the diction itself, saying the method of attack. And so it's one of those things that I've been kind of thinking about in terms of I think that some people will read that and view it as kind of malicious intent, we'll say. And so it's one of those, yes, but it's also like when you're trying to win an argument, in a way, he's basically arguing for a complete reform of the monetary system of the United States and actually eventually the entire planet, right? Based on, and that's the whole point. And so like it is kind of an attack in a way. And so it really depends on your own personal point of view. I don't know. It's early and I don't think I articulated it that well. Basically my point is I think that people place undue value judgments on certain statements depending on diction. And now granted, there is a form of, that's a very important part of marketing in terms of like the word choice that he gave and that sort of thing. And yes, he's an academic, but also dealt quite heavily in propaganda, and that's not exactly conspiratorial to say, like it's rather explicit in some of the history and the work that he's done. And so, and I'll elaborate on that further as we get to that specific parts, right? So just keeping that in mind. Okay. A touch on the safety of the system itself is basically, let's see, right. It's hard to read when it's dark outside. So safety, in other words, was sought by circumscribing the realm of activity of the central institution to such a degree that no outside individual, firm, or bank could have direct access to its resources. As a further safeguard, local boards in which control was divided between representatives of banking, commerce, and the government were designed to supervise the activities both at the branches and at the head office, right? So basically the part to emphasize is that no outside individual, firm, or bank could have direct access to its resources. Really talking about, you see this with the member banks and who can have a reserve account at the Fed, right? At least that's what pops in my mind. So only depository institutions can have reserve accounts, and basically everyone else can either nowadays use like the repo market or some other form of liquidity, right? Or access to liquidity. And so that's kind of the whole point, is to, and this was an interesting point in the actual development of the bill itself, or I guess the concept, whatever, to basically who gets access to it and whether or not you should involve mostly state banks, because it seemed like there was a consensus that national banks should be allowed to be a part of the Federal Reserve System, but not so much state banks. There was a little bit of argument about that. And so basically they have I think national banks are required, or were required back then, to join the Federal Reserve System and fulfill the necessary requirements or prerequisites to be able to be a member of such system, mostly like reserve requirements in a way. There was various other ones, we'll get to that at some point, breaking it down itself into what exactly those requirements were. But basically it was optional for state banks. They could basically try, but when state banks decided to become a member bank of the system and to become a depository institution, they had to fulfill the same prerequisites as the national banks, right? So it's not like they got kind of dumbed down requirements. They still had to fulfill the same ones. It's just they had the option, whereas national banks did not, right? But anyways, everything else in here is pretty much the same thing. I guess the only other thing of interest would be with Frank A. Vonderlip. Basically, he admits to having a decent amount of correspondence, we'll say, with several letters in Warburg's files, in which he encouraged him to continue in my efforts. So basically Vonderlip was a very encouraging figure for Warburg in this whole kind of arousal of public opinion towards central banking, right? And he actually, to use his own words, explicitly calls it central reserve gospel, right? To where it's kind of gets a little bit of a religious sort of feel to it. Again, could just be a word choice. I mean, people say what they say. Sometimes there's not necessarily a reason for specific word choice, right? But again, in an 800-page book, maybe there is. But that's all I got for this one. So, yeah, basically the Fed was supposed to make liquidity problems, and we'll see if I can get the exact wording again, currency famine and money panic to become impossible. And that's not exactly how it happened. But anyways, I'm going to leave this one here. So I hope you guys have a good day, and I will see you on the next one.